Hi everyone, welcome back. My name is Paddy and I am really happy about this big news. So Netflix just announced a 10-for-1 stock split happening on November 14th, which means that if you are already invested in Netflix at the start of trading day, I believe on the 17th, which is a Monday, I believe, you are going to see a multiplication of your stocks in 10 folds. And a lot of guys on Wall Street are very happy about this news. Now, if you are new to investing and don't understand what this means, it simply means that Netflix stocks, which are currently trading slightly over $1,000 at the time of making this video, are going to be way cheaper on a face value after the split. And I'm explaining what this means, the impact of the stock split on employees, and in a broader spectrum to you as a retail investor. Now, to be specific, Netflix announced that they are also doing this to help their employees, and that is why I will be touching base on that aspect. Now, the question is, does this automatically make you richer as an investor in Netflix or someone who is thinking of investing in Netflix? Let's understand this. In a split, a company basically divides its existing shares into smaller pieces, like cutting a pizza into more slices, all right? It doesn't really change the size and the price of the pizza. And in this case, it doesn't change the company's total value. It just gives investors more smaller shares at affordable prices. Let's assume you own one Netflix share, which is worth $1,000. After a 10-for-1 split, you would own 10 shares worth $100 each, which means if you are already invested in Netflix, the total value of your investment doesn't change. It stays the same. Okay, and companies usually do this when their stock price, gets too high for the average investor. And the thing is, as lower share prices make the stock feel more affordable, it usually increases liquidity because it widens the participation bracket and tends to have a positive impact on the performance of the company in the long run. Remind you, this is not an investment advice to buy Netflix after the split or at the split, but this is the data and the picture that I'm trying to paint to you. In 2020, Apple had a 4-to-1 split in August, and in the year following the split, the stock rallied over 30%, outperforming the S&P 500 during the same period. Yeah, during the same period, I have to be specific. In the same year, Tesla had a 5-for-1 split, and in the year following that, the stock surged over 70%. Also note that the split coincided with an explosive growth in Tesla's fundamentals. So it wasn't just because they became cheaper. And then my beloved Nvidia just recently in 2024 also had a 10-for-1 split, and it surged nearly 40% in the year following the split. Now, Nvidia in particular had a 4-for-1 split in 2021 when the share price was roughly around $800. After the split, the share became roughly $200, and in just 3 years, the share got to $1,200. When they had their second 10-for-1 split. In just 3 years, the share got to $1,200 when Nvidia had another 10-for-1 share split. So the point here is that these splits are aimed at making shares more affordable, and in as much as the positive performances were driven primarily by underlying business growth, like I said, the fundamentals of the company, we can't rule out the fact that these splits helped attract new investors and boosted liquidity. So as to whether you automatically become richer, we can accurately say that the splits do not create instant value. You don't magically get richer because your shares multiply, but it increases trading activity. It attracts new investors who were previously priced out, and this definitely creates value over time. The second leg of this video, which is also very important, it says that Netflix is saying that the split will help its employees. Question is, how is this supposed to help them? Most of these guys, I would imagine, are already very happy working because they are making a lot of money already anyway. So how does a stock split help them? And it is important to understand this part of the video because it has a direct correlation on the performance of the company eventually. All right, and this is the explanation behind it. Netflix, like many tech companies, compensates staff with what is called stock options. This is not the only way, but it is one of the commonly used innovative strategies to motivate employees. Under stock options, employees get the opportunity or the right to buy a certain number of stock shares at a fixed price, which is known as the strike price. after a certain period of time. Now, let's break this down. Supposing you join the company at a time where a share of the company costs only $80. Now, they give you the option. Remember, it is just an option. It's like a discretion and it is not an obligation, right? So they give you the option to buy a share of the company for $100 per share. The $100 here, like I said, is the strike price. Now, at this point, the $100, which is the strike price, is higher than the $80, which is the market price. So it wouldn't make sense for you to pay $100 for a share that is selling for just $80 in the market. But in a year later, the company performs so well and the share price has moved from $80 to $500 in the market, which is not surprising because it usually happens, right? So now you are so happy as an employee because contractually you can still buy this share for just $100 and keep it or immediately sell it for $500 and make a profit of $400. So imagine employees having the right to buy hundreds, thousands, and even millions of these shares. That is a lot of money. Now, the link here is that if a share of Netflix costs $1,000 or slightly over $1,000 as it is right now, it makes it very difficult for employees to exercise their stock option agreement because it creates a very high upfront payment or cost. So by splitting the shares into smaller pieces, it makes it affordable for employees to exercise their stock options because they get affordable strike prices and make a lot of money when the company performs well. Now, the catch here is that some of the requirements under the stock option agreement is that employees remain in the company during the vesting period. And even sometimes the companies attach a performance milestone to be achieved before the options become exercisable or vested. So it is a very strategic way to maintain these top talents and these very smart employees, and also make sure that they work very hard to improve the fundamentals of the company. Okay, so the question here is, if you bought Netflix at the split, are you in for a ride or not? Because these guys are really going to work so hard to improve the fundamentals of the company so that they can exercise their stock options by all means. Now, historically, Netflix has had two stock splits. 2004, they did a 2-for-1 split after their first strong early growth. So share price moved from $35 per share all the way to $700 in 2015 when they had their second split, which was a 10-for-1. Now from 2015, share price has moved all the way from $100, that is after the split, to a new over $1,000 today, for which reason they are doing their third split. All right, so the fact is, stock splits are not new. They've been there for a long time, but they often happen when a company feels very confident about its future. All right, so what is Netflix trying to communicate to us? Are they trying to communicate something? Are they saying that, hey, we are very confident in our trajectory and we want more people to join the ride? Just look at the fundamentals. You can let me know in the comment section. Thank you very much for watching. If you enjoyed this video, please hit the like button, subscribe, and share for other people to enjoy. My name is Paddy, and I'll see you in the next video.